Ever wonder what happened after the 2008 financial crisis? We all remember the headlines, the bailouts, the promises of a safer financial system. But while we were watching the front door, a whole new financial world was being built in the shadows. And today, that shadow world has grown into a $2 trillion giant that's quietly reshaping our entire economy. For decades, the system was simple. If a company needed a big loan, say, $100 million to build a new factory or buy a competitor they called their bank, the bank was the center of the financial universe. But after 2008, everything changed. Regulators, trying to prevent another meltdown, put a tight leash on the big banks. Suddenly, making large, complex loans became much harder and more expensive for them. They had to be more cautious, lending mostly to picture-perfect, low-risk clients. As the banks pulled back, they left a huge void. And as the old saying goes, nature and finance abhors a vacuum. Into this space stepped a new breed of lender. They didn't have fancy marble lobbies or ATMs on every corner. They operated privately, away from the public eye. Not because they were doing anything illegal, but because they weren't public companies. Welcome to the world of private credit. So, what exactly is private credit? In simple terms, it's just a loan made by an institution that isn't a bank. But let's use an analogy to make it clearer. Getting a loan from a traditional bank is like getting a standard mortgage. You face mountains of paperwork, rigid rules, and your bank might just turn around and sell your loan to another institution next week. You're just a number on a spreadsheet. Private credit, on the other hand, is like getting a loan from a very exclusive, very sophisticated private club. This club is made up of savvy investors with deep pockets. The terms are flexible and tailored to your specific needs. The deal gets done quickly, without the red tape. And most importantly, the club holds onto your loan for the long haul. They're not just a lender, they're a long-term partner. This wealthy club is typically a private credit fund, a massive pool of capital managed by financial titans like Blackstone, Apollo, or H. These are names you might have heard in the news, often associated with huge corporate buyouts. But their private credit arms are the engines working behind the scenes. Just 15 years ago, this was a tiny, niche corner of the financial world. Today, private credit is a global behemoth worth over $2 trillion. To put that number into perspective, if the private credit market were a country, its economy would be larger than that of Italy, Brazil, or Canada. Here in the US, it's now roughly the same size as the entire high-yield bond market. You know, the market for junk bonds has gone from a small side act to a mainstay headliner. So, where is all this money going? Initially, it flowed to what's called the middle market. These are the backbone of the American economy. They read businesses that are too big for your local community bank but not quite big enough to be listed on the New York Stock Exchange. We're talking about software companies needing capital to expand their sales team, healthcare providers buying new MRI machines, or even infrastructure projects like new solar farms or toll roads that will serve your community for decades. These are the real, tangible businesses that create jobs and drive growth. Private credit became their financial lifeline when the banks said no. But if this market has been quietly growing for over a decade, why is it suddenly making front-page news in every financial publication? Why are we talking about it right now? Because the game has changed. The direction of travel, as insiders call it, has shifted dramatically. Private credit is no longer just filling the gaps left by banks. It's starting to dominate. These funds are no longer just financing mid-sized companies. They're moving into every facet of lending. They're financing huge real estate developments, funding car loans, and even providing the billions needed for the world's largest corporate takeovers deals that were once the exclusive domain of Wall Street's biggest banks. But here's the most important shift, and it's the one that affects you and me. This isn't just a playground for the ultra-rich anymore. Through new types of investment funds, regular retail investors are now getting a piece of the action. More significantly, the money that powers these giant funds often comes from pension funds. That's right, the money that's supposed to secure the retirement of teachers, firefighters, and millions of other workers is now flowing into private credit. Your pension fund might be one of the biggest investors in this new financial world. This brings us to the big $2 trillion question. As this market grows larger, more interconnected, and more complex, it is becoming systemically important. That's a fancy way of saying that if private credit catches a cold, the entire global economy might start sneezing. What happens if the loans made to those thousands of companies start to go bad? What happens if investors suddenly want their money back? These are the questions that regulators, economists, and even the central banks are starting to grapple with. There are a couple of key things to watch for. The first is something the industry calls dry powder. This is cash that has been committed by investors like those pension funds, but hasn't been lent out yet. Right now, there is nearly $1 trillion of dry powder sitting on the sidelines, waiting to be deployed. That's a tidal wave of capital ready to reshape industries. The second thing to watch is how the big banks are reacting. You might think they'd be fighting tooth and nail against these new competitors, but instead, we're seeing a different trend. Many banks are choosing to partner with private credit funds. The bank might find the client, but the private credit fund provides the cash. It's a classic case of if you can't beat him, join him. This is a story with huge implications for everyone. It's about who holds the power in our financial system, where the risks are hiding, and how the future of our economy is being financed, one private loan at a time. And we've only just scratched the surface. In our next video, we're going to dive even deeper. We'll look at the anatomy of this boom, breaking down exactly how these funds are structured. We'll explore where this ocean of cash actually comes from and how these fund managers are able to promise such high returns to their investors. Even in today's uncertain world, we'll also unpack a concept that seems counterintuitive. Why locking up your money for 7 to 10 years is actually considered the greatest strength of private credit, not its weakness. It asks a fascinating look under the hood of the machine that is moving trillions of dollars from pension funds to Main Street businesses, and you won't want to miss it. Thanks so much for watching. If you found this breakdown interesting and want to understand the hidden forces shaping our world, make sure to subscribe and hit that notification bell so you don't miss part 2. See you in the next one.